All right, so continuing where we left off in the space of contract law, definitions and keywords that have to do with contract law, such as consideration, and how that's tied into Article 1 of the Constitution, dealing with essentially the right to contract, or specifically, there can be no obligations placed on contracts. And then, of course, once again, you have contract law. Contract law, which has bullet points and basics and fundamentals that have to be adhered to, right? Such as we learned so far, for a contract to be binding, it cannot be unilateral, right? Must have multiple signatures if there's multiple parties. Another one, right? A minor cannot be a party to a contract. These are maxims. These are maxims of contract law. For example, all right, so we're continuing in that space. All right. So we have legal consideration. One recognized or permitted by the law as valid and lawful, as distinguished from such as are illegal or immoral. The term is also sometimes used as equivalent to good or sufficient consideration. And then it references case law, Sampson versus Swift, also Albert Lee College versus Brown. So transition into the definition of pay. To discharge a debt, to deliver to a creditor the value of a debt, either in money or in goods for his acceptance. Case law to support that. So as you can see, pay has the elements of acceptance, discharging a debt, deliver the creditor something of value, so it's either money or something to accept it. And now, once again, the lessons from the previous class, money is money, right? Gold, silver. But anything outside of money in law, only way it flies is if it's accepted. So keep these things in mind. And Bills versus Holmes Incorporated, as well as Carpenter versus Dummett, corroborates that fact in res judicata, which is connected to Article 4, Section 1. That no power has been expressed, conferred upon Congress, and this is also codified in 79 USC, or United States Codes 457 and 464. So that no power has been expressly conferred upon by the Constitution to make the treasury notes of the government a legal tender between private individuals. Discharge of pre-existing debts must be admitted. Money is used in the Constitution in two senses. In the second subdivision of the section related to the powers of Congress, the Constitution speaks of the power to borrow money. And there the word must be used in the larger sense of strict money or anything received instead. But in the fifth subdivision of that section, which gives Congress power to coin money and regulate the value thereof and of foreign coins, it must be evident that Congress referred only to metallic money, right? Gold and silver, metal. Metallic, the root word is metal. Gold, silver. From time immemorial, In all countries, in all ages of the world, the precious metals have been the medium of exchange, and the strict monies, the value of these metals has been designed by a stamp upon them indicating their fineness and weight. That is, indicating the value at which the coins were rated. When the coins have possessed the value indicated, they have passed from hand to hand as of that value, right? Exactness, certain amount of weight, weights and measures. That's the language. When they have been found not to possess that value, they have, except within narrow limits, failed to so pass. Not only has money meant metallic money, but upon looking at the public history of the times, which this court has established as a proper guide to the construction of the Constitution, we find that in the history of the country, there was no period in which money was more distinctly understood and meant to be hard money than at the period of the Constitution was framed and adopted. Its framers had just passed through all the horrors of the underdeemed or the unredeemed paper currency. The history of that currency had been within the view of those who stacked their property on the public faith, always freely given and glossily violated. The mischiefs of the various experiments that had been made were fresh in the public mind and had excited general disgust. With the bills of the government unredeemed, indeed, became at least so hopelessly beyond redemption as to then entirely given up as worthless. The country had returned for circulation to a species currency, to absolute money having an intrinsic value, and neither had nor wished any other currency. But the context, as well as the word itself, shows that the power is confined to metals. This grant is not a grant to create money, but simply to coin money, a power that can be exercised only on money that admits of being coined. That is a bare power to strike coin, which was the phrase used in the Articles of Confederation as the equivalent to quote unquote coin money. It was from those articles that the power to coin money and regulate the value thereof was transferred to the existing Constitution, and that this provision only gave Congress power to strike coin and regulate its alloy and value. And that's codified in 79 United States Codes, Section 457, as well, as far as coin being money. The Federalist number 43 tell us the right of coining money, which is here taken from the states, was left in their hands by the Confederation as a concurrent right, which that of Congress under an exception in favor of the exclusive right of Congress to regulate alloy and value. And that's back to Article 1, Section 10, weights and measures. In this instance, also, the proper provision is an improvement on the old, whilst the alloy and value depend on the general authority. A right of coinage in the particular states could have no other effect than to multiply expensive mints, and diversify the forms and weights of the circulation pieces. Treasury notes have as substance no appreciative or appreciable value. They are not declared to be and do not purport to be of any value as substance. They are not stamped with any intrinsic value. They are not, so far as they possess value, things at all, but only things in action. The material holds the evidence of the promise, but it is the promise and the promise alone which is and which purports to be of value. substance of value, right? So back to, you got gold, silver, it has how many ounces it is. Back to weights and measures, because that's the language of Article 1, Section 10 of the Constitution, dealing with what money is. And thus far, we've been distinguishing the Federal Reserve notes and law, just going, not just making blanket statements, but we've been going through case law Wednesday, and we're continuing from Wednesday, supporting what lawful money is. So we're continuing on that wave, and elements of it, once again, consideration. What that is, consideration is contract law terminology. And when you're talking consideration, you're talking about an element to make a contract binding. It must be consideration. What is the element of consideration? It must be money or something of value given and agreed upon to do X, Y, Z. And so that's the connection. So we're kind of continuing on that wave from Wednesday. If therefore money, in the phrase to coin money, could be considered as embracing other substances besides those precious metals alone, in use throughout all the world as coin, none less would it remain that to utter promises to pay money will not be coining, or to coin money. And right, to support that, United States Supreme Court legal tender cases, 1870, number 43, argued and decided. So it was argued and decided. What we're talking about, December 1st, 1870. More case law, U.S. versus Long. An informed jury found Mr. Long not guilty of willful failure to file a tax return. In Don E. William versus Commissioner of the Revenue Services, right, IRS, the Supreme Court, quote, a note even when and payable on demand and fully secured is still only a promise to pay, since the Federal Reserve notes are not secured and payable on demand. According to law, they are only a promise to pay and not payment. Right, so these are, once again, things that we can use Article 4, Section 1, res judicata, on multiple levels of things, right? So I want to say happy holy day. Who came? We got Ali Khan, happy holy day. Islam.
Ali Khan, happy holy day, my bad.
You got, who else came in here? Hanun Islam, happy holy day. Matazamaji, happy holy day, Islam.
Islam, Moors, Islam.
Islam, Moors, happy holy day, happy holy day.
Happy holy
Islam,
day.
happy holiday.
Happy holy day.
Happy holy day, Islam.
Yeah, while I transition to the next segment, I want to get on, a couple people came in. All right, so more case law just to have in our downloaded in our mind, in our files, to know what we can pull from dealing with these issues. So we got a United States Supreme Court case, Craig versus State of Missouri, 1830 case. It was argued and decided January 1st, 1830. The specifics, it was a writ of error submitted to the Supreme Court of the state of Missouri. So once again, whoever, when you look at writ, we're dealing with a command in an affidavit form. So the writ of error. So it was a command saying that it was an error, and that was filed to the Supreme Court of the state of Missouri. So in 1823, an action of trespass on the case was instituted in the circuit court for the county of Chariton in the state of Missouri by the state of Missouri against Hiram Craig and others. The declaration set forth the cause of action in the following terms. End quote. For whereas heretofore on the first day of August in the year of our Lord 1822, these are transcripts of the case, at the county of Chariton, aforesaid, the said Craig John Moore and Ephraim Moore made their certain promissory note in writing, bearing the date and year aforesaid. And now to the court here shown and thereby, and then and there for value received, jointly and severally, promised to pay to the state of Missouri on the first day of November 1822 at the loan office of Chariton the sum of $190.99, and the the interest occurring on the certificates borrowed from the first day of October 1821. Nevertheless, the said Hiram Craig, John Moore, and Ephraim Moore did not on the first day of November or at any time before or since pay the state of Missouri at the loan office in Chariton the said sum of $199.99, or the 2% per annum, the interest occurring on the certificates borrowed from the first day of October 1821, but the same pay to and etc. Congress had no express authority to issue treasury notes. What is a bill? What is a bill? What is a bill of credit? Did the Constitution mean to forbid in its enlarged and perhaps its literal sense the term bill of credit may comprehend any instrument by which a state engages to pay money at a future date, thus including a certificate given for money borrowed or promissory note, to emit bills of credit, convey to the mind the idea of issuing paper intended to circulate through the community for its ordinary purposes as money, which paper is redeemable at a future date. This is in the sense in which the terms have been always understood. Such a medium has been always liable to considerable fluctuation. Its value is continuously changing, and these changes, often great and sudden, expose individuals to immense loss, are the sources of ruinous speculations, and destroy all confidence between man and man. To cut up this mischief by the roots, a mischief which has felt through the United States, and which deeply affected the interests and prosperity of all, the people declared in their Constitution that no state should emit bills of credit. If the prohibition means anything, if words are not empty words, it must comprehend the emission of any paper medium. The history of paper money has been referred to for the purpose of showing that its great mischief consists in being made tender, and that therefore the general words of the Constitution may be restrained to a particular intent. It has been long settled that a promise made in consideration of an act which is forbidden by law is void. It will not be questioned that an act forbidden by the Constitution of the United States, which is the supreme law, is against the law. And that's in reference to paper money as a circulating medium. That which is not permitted to do directly cannot be legalized by any change of names or forms. Acts done in fraudum legis or fraud are acts in violation of law. Craig versus State of Missouri is a court case you can reference to support the fact that it was ruled that paper money is not lawful money, to summarize. All right, more case law. Debt is not paid by the giving of a note, right? We have Nolan County versus Maryland Casualty. More case law, a note is only a promise to pay, not an instrument. Fidelity Savings Bank versus Grimes. A check payable in notes is an altered instrument and void. MRS. So section 411 of Title 12 United States Codes reads as follows. Federal Reserve notes to be issued at the discretion of the Federal Reserve Board for purposes of making advances to the Federal Reserve banks. The said notes shall be obligations of the United States. Transitioning to 115th Congress, and once again, it's more res judicata, case law, public records, House resolutions, to define the dollar as a fixed weight of gold. Now, to keep in context, as we've been transitioning since Wednesday, we went from Allodial title and cross-reference that with the Constitution. So when we're talking about mortgages and things of that nature, we're talking about, was it consideration? Was it something of value actually given? You know, did somebody really give you $500,000 and then you took that hard cash and bought a house? Is that really what happened? All right, so then we transition to what money is and what money is not. The whole thing is to put have these tools back. It's back to the toolbox. You just want to be sharp in a lot of areas because you may be in a situation where you need to know this and invoke this info. You just know it. Repetition. It'll come a point where that'll be useful. Especially if it's like a big Moorish community. Bunch of a big community, everybody know law. So this is more res judicata. This is a congressional record. It was actually not that long ago, actually. This was 2018 in March 22nd. So this was actually right after New Year's, spring equinox. So this is a House representative case. So once again, this is what is 115th Congress, 20th section, or simply House Resolution 5404. You know, that'd be simpler. House Resolution 5404 is what I'm about to go into. All right, so these are the transcripts. So Mr. Mooney of West Virginia introduced the following bill, which was referred to the Committee on Financial Services. The bill states to define a dollar as a fixed weight of gold. This is 2018. This wasn't, hundreds of years ago. Be enacted by the Senate and the House of Representatives of the United States of America and Congress assembled. Section 1, findings. Congress finds the following. 1, the United States dollar has lost 30% of its purchasing power since 2000 and 96% of its purchasing power since the end of the gold standard in 1913. 2, under the Federal Reserve's 2% inflation objective, the dollar loses half of its purchasing power every generation, or 35 years. 3, American families need long-term price stability to meet their household spending needs, save money, and plan for retirement. 4, Federal Reserve policy of long-term inflation has made American manufacturing uncompetitive raising the cost of United States manufactured goods by more than 40% since 2000, compared to less than 20% in Germany and France. 5, between 2000 and 2010, United States manufacturing employment shrunk by 1/3 after holding steady for 30 years at nearly 20 million jobs. 6, the American economy needs a stable dollar, fixed exchange rates, and money supply controlled by the market, not the government. 7, all these are reasons in 2018 why a dollar needs to be a fixed weight of gold. 7, the gold standard puts control of the money supply with the market instead of the Federal Reserve. 8, the gold standard means legal tender defined by the convertible into a certain quantity of gold. 9, under the gold standard through 1913, the United States economy grew at an annual average of 4%, 1/3 larger than the growth rate since then, and twice the level since 2000. 10, the International Gold Exchange standard from 1914 to 1971 did not provide for a United States dollar convertible into gold, and therefore helped cause the Great Depression and stagflation. 11, the Federal Reserve's trickle-down policy of expanding the money supply with no demand for it has enriched the owner's financial assets by endangering the jobs, wages, and savings of blue-collar workers. 12, you got a long list. Restoring American middle-class prosperity requires change in monetary policy authorized to Congress in Article 1, Section 8, Clause 5 of the Constitution. What are they referencing when they say Article 1, Section 8, Clause 2, or 5 rather? We already know Article 1 is dealing with gold and silver, coin. We know Article 1 is dealing with the right to contract, and no obligations can be placed on contracts, right? And once again, that opens the door to what? Contract law. So now we need to know the maxims of contract law, because that's a whole course. People take contract law. It might take 8 months, however, a couple semesters or whatnot. And people complete a contract law. They be certified. No, I know contract law. You know, it's a thing, right? It's elements to contract law. And once again, a couple maxims would be a minor cannot enter into a contract. One cannot be unilateral. If it's 3, 4 parties involved in the contract, it needs to be 4 signatures, 3 or 4 signatures, not just one. Right? It must be consideration. That's the recurring theme, consideration. That's a law term, something to value. These are maxims of contract law. So now you see the maxims in the court cases. You see how the maxims is connected to the Constitution. So that's how you address distinguishing Federal Reserve notes from gold and silver. Of course, it's a bartering system, and most people is using it. But the whole thing is, you may be in a position where you need to know this. That's just the bottom line. More res judicata. United States Supreme Court, Don E. Williams Company versus Commissioner. This is a 1977 case. Supreme Court case in 1977. It was argued and decided December 8th. Argued and decided. So argued December 1976, it was decided February 22nd, 1977. All right, so we got the petitioner, Arcrio basis corporate taxpayer, by delivering fully secure promissory demand notes to the trustees of its qualified employees, profit sharing trust held not entitled to income deductions. Therefore, under 44 or 404 subsection A of the Internal Revenue Code of 1954, which allowed a deduction for contributions, quote unquote, paid an employer to a profit sharing plan in the taxable year, quote, when, quote unquote, when paid, and further allows the deduction if the contribution was a quote unquote payment made within the specified grace period following the end of the employer's taxable year. Now, that's more reference. Reference that Internal Revenue Code, right? So subsection A of the Internal Revenue Code of this particular section of 404. The statutory terms, quote unquote, paid and quote unquote payment, coupled with the grace period and the legislative history's reference to quote unquote paid, is actually paid, quote unquote, demonstrated that regardless of the method of accounting, all taxpayers must pay out cash or its equivalent by the end of the grace period in order to qualify for the section 404 subsection A deduction. This accords with the apparent statutory policy that the profit sharing plan receive full advantage of any contribution that entitles the employer to a tax benefit, where the petitioner's issuance and delivery of the promissory notes did not make the accrued contributions ones that were quote unquote paid within the meaning of 404 section A, right? More ways to skin the cat on your position on promissory notes. You can't pay somebody with a promissory note because clear as day it's called a promissory note, for one. But outside of the obvious, you want to use, like I say, once again, you want to be more scholarly in this, because 9 times out of 10, when you're having to show competence in the area, you're going to be dealing with people, you know, with suits and robes and stuff. So it's not like you're talking to somebody on the street. You know, you want to kind of show some competence, have it flow in a logical manner to show like, you know what you're talking about, and more tools in the toolbox. Subsection B, though the notes had value and would qualify as income to a seller recipient, the notes for the maker, even though fully secured, are still only a promise to pay and do not in themselves constitute an outlay of cash or other property. Internal, well, these are court transcripts relating to the Internal Revenue Code. Subsection C, the transactions in question cannot be treated as payments of cash to the trustees, followed by loans evidenced by the notes in return, since, quote, a transaction is to be given its tax effect in accord with that actually occurred and not in accord with what might have occurred, unquote. To substantiate that point, another court case, Commissioner versus National Alfalfa Dehydrating. So that was actually a United States Supreme Court case. Subsection D. The word quote unquote paid in 404 subsection A, remember the Internal Revenue Code, cannot be assumed to have the same meaning it has in 267. Subsection A of the code, which disallows deductions by an actual basis taxpayer for certain items that are accrued but not yet paid to relate cash basis payees. The situation under this is all you can also reference 429, 569, and 570 United States Code is parallel. But 267 subsection A of the Internal Revenue Code, whereby the term quote unquote paid has been used to ensure that transactions between related entities received consistent tax treatment, has no counterpart under 404 subsection A for the qualified profit sharing plan is exempt from tax. E, a promissory note cannot properly be equated with a check, since a note, even when payable on demand and fully secured, is still only a promise to pay, whereas a check is a direction to the bank for immediate payment, is a medium of exchange, and is treated for federal tax purposes as a conditional payment of cash. And then, of course, it was affirmed. And the opinion, even got the people that made the opinion. All right. So we got more res judicata, which we'll pick up on Wednesday. I want to open the floor if anybody got any questions on the matter, especially Charissa, Brother Elijah, but anybody in general. I want to open the floor for questions, analysis, anything.
Islam.
Wow.
Yeah. Well, one question is, I was trying to find this PDF online. I couldn't find it. Are you able to send it to me?
PDF. I can email this to you.
Just-
Yeah.
Yeah, the state law. Yeah.
Yeah.
I yield right now. I think another question.
Brother Elijah. Got any questions, Brother Elijah or Charisha?
I got nothing. I got nothing. It's a lot to unpack again. It's a lot to unpack again on this one. But I was having a conversation not too long ago about the notes. So like, I don't know, it's hit me in the head kind of sideways right now.
Okay, Islam.
Islam, these some of these codes could be used for discharging as well, right? That's basically what some of them.
Yeah.
Yeah.
Because if somebody's saying, that's the whole point. If somebody's coming after you saying they gave you a loan or something like that, and you fed up, you don't want to deal with it, and you want to come at them with an adverse position, you just want to know these principles. Because when you're saying discharge and debt, that's all you're really saying is like you're competent enough to have a position, right?
Yep, there's no paying, only discharging, really.
Yeah. And you know what I mean? and I think I mentioned Wednesday, we got multiple ways to go about it. You know, we're talking about the case law just to keep it consistent with Article 4, Section 1 to support. You know, it's been multiple cases where it's been ruled that what is what? You know, money, gold and silver, promise to pay. It can't be looked at as money because it is what it is, promise to pay. So it's case law, right? And then you got on the other side, right? We're dealing with securities, right? Like we talked about on Wednesday. Now you're dealing with SEC, right? SEC, right? The Security Exchange Commission. That's a whole nother. They got their own police, like, you know what I'm saying? They come and arrest you for securities fraud. So when you look in there, you're gonna see that the mortgage is a security is being invested in the secondary. They call it the lenders call it the secondary market. But essentially, what they're saying is that instrument, that instrument that you created, that negotiable instrument, that's the lingo in the finance world. Negotiable instruments. So that mortgage, that promise to pay, once you signed off on it, you put a negotiable instrument in circulation, and people invest in it, right? That's what we talked about Wednesday. On the flip side, people can invest in what they call mortgage notes. And then on the other flip side, people that are paying a mortgage at 8%, right? Fixed or adjustable. And on the other side, you can invest in mortgage notes at 8% and get 8% return on your money, right? So that shows you right there, right? So back to that example I gave on Wednesday. So now that's why I brought up securities. That's why it's a security, because it's being invested. So once you can prove that it's being invested and that you have, because see, if it's called a holder in due course. If that's your instrument, if the instrument needed you to even get put in circulation, you're the holder in due course. So any money that's made off that, for one, they're supposed to notify you that you got some return, right? A yield on your investment. And two, anytime they reassign a contract, they're supposed to let you know, right? So these are Security and Exchange Commission laws that I'm talking about now, right? On how to deal with a security, because that's what it is. So I'm just bringing that up because, like I say, you just want to have your head on the swivel, because you might be in a position where you got to invoke this stuff, like, and you just want to be sound on how you're gonna come at it, you know. Wow.
I'd like to read more on this, on the houses. And what is that, owning property? That's what I see.
What do you mean specifically? Like, you said the houses, like as far as
Owning a house or either renting, you know?
I think when I mentioned you might have heard me say mortgage, and
Mhm.
that's how it's a security. So so if somebody was to come foreclose on some
Mhm.
property or try to attempt to foreclose you because, for instance, you missed a couple months or whatnot. These are just laws and things of that nature for you to have to combat that.
Mhm.
That's the capacity that I was speaking of. I wasn't really talking, you know. Does that make sense?
Yes, understandable.
Yeah. Did anybody have any other questions, comments? I have once again this week, Charissa, I have the ID made. And of course, brother Imani Elijah, I have yours, like I said, by Sunday, ideally. And then you're doing a presentation. Okay, so yeah, a presentation this Sunday from Brother Elijah. That's on the agenda for
Yes,
Sunday.
sir. I'll be ready.
Okay. Anybody, I'm gonna do one more round for any thoughts, concerns, anything in general.